If you're investing inside your corporation, maybe through your holdco or operating company, here's something you need to know. Not all investment income is taxed the same. In fact, the type of income your corporation earns can quietly cost you thousands in unnecessary tax or help you grow your retained earnings far more efficiently over time. Take two common types of income. Interest, like from a GIC, corporate bond, or high interest savings account. Capital gains from stocks, ETFs, real estate, or other appreciating assets both grow your corporate portfolio. But one gets taxed at over 50% and the other often at half that, or even less, depending on how it's realized. Here's the problem. Most corporate portfolios are built without any tax planning. They just chase yield. And when that income hits your tax return, you're left wondering why your accountant says you owe so much. That's what we're going to fix today. Hey there, I'm David Drummond, founding partner at DLD Financial Group. We help corporate professionals and business owners across Canada structure their investments and tax strategy so that they can grow their wealth, protect what they built, and retire with confidence. And one of the biggest mistakes that we see, holding the wrong type of investment income inside the corporate structure and paying tax that could have been avoided with just a bit of planning. In this video, I'm going to break down how interest, income, and capital gains are taxed inside a corporation, why one is far more efficient than the other, and how to design your corporate portfolio to keep more of your after-tax growth. If you're investing retained earnings through your business, this is something you need to see. Let's get started. Part 1. How investment income is taxed inside a Canadian corporation. When you earn non-registered investment income personally, you probably already know it gets taxed. But how? Depends on the type. Interest gets taxed at your full marginal rate. Capital gains are 50% taxable. Dividends have their own special rates. Inside a corporation, it's similar, but the rules get a bit more complicated. And this is where the planning opportunity begins. Let's start with interest income. If your corporation earns interest from things like GICs, bonds, high interest savings accounts, term deposits, that interest is considered passive investment income. And here's the kicker. Passive interest income is taxed at a high rate inside your corporation, often over 50%, depending on your province. Why? Because the CRA wants to discourage passive investing inside a corp without proper planning. Now, part of that tax is refundable when the corporation pays out dividends, but it's still an inefficient way to grow wealth inside the company, especially if you don't need the income right away. Now, compare that to capital gains. Capital gains are triggered when your corporation sells an asset for more than it paid, whether that's a stock, ETF, investment fund, or even real estate. Only 50% of the gain is taxable, just like personally. And better yet, capital gains don't count as active income, but they also don't grind your small business deduction as aggressively as interest does. If your corporation can hold investments long-term and harvest capital gains strategically, then you can build serious after-tax wealth much more efficiently than with interest-based products. What's the bottom line? If you're investing inside your corporation and not paying attention to the type of income you're generating, you could be paying twice as much tax as necessary without even realizing it. In the next section, I'll show you exactly why interest income is so heavily taxed and how the refundable tax system works, because once you understand it, you'll know why capital gains are often the smarter long-term play. Part 2. Why interest income is taxed so heavily and what you can do about it. Let's take a closer look at why interest income inside a Canadian corporation gets hit so hard by tax and what options you actually have. Because when you understand the mechanics, the planning opportunities become clear. Why interest income gets punished in a corporation. When your corporation earns interest from GICs, corporate bonds, or a high interest savings account, it's treated as passive investment income under the income tax rules. And here's the problem. Passive income isn't tied to your core business. Like, government doesn't want corporations to be used as tax sheltered for investing. So the CRA taxes passive interest income at the highest possible corporate rate. That's often over 50% depending on your province. Let's say your corporation earns $100,000 in interest from GICs in a given year. About $50,000 of that goes to the government in tax. And it happens every year because interest income is realized annually, not just when you sell. But isn't some of that tax refundable? Yes, and this is where it gets confusing. When a corporation earns passive income, part of the tax is held in a special account called the Refundable Dividend Tax on Hand, RDTOH. RDTOH is basically a credit your corporation can get back, but only when it pays taxable dividends to you personally. So to recover the tax, your corporation has to issue a dividend. You have to pay personal tax on that dividend. Then the corporation gets a refund, usually about 30% of the passive income. And let's go back to our example. If your corporation earns $100,000 of interest income, about $50,000 goes to tax, maybe $30,000 $50,000 of that is refundable, but you don't get it unless you issue dividends and pay personal tax on those dividends. So it's not really a refund. It's a tax deferral with strings attached. Why this matters for long-term planning? If you're not planning to draw income from the corporation soon, say you're still building your retained earnings for retirement or future investments, then issuing dividends just to recover tax may defeat the purpose. Instead of growing inside the corporation efficiently, your money is getting taxed at the top rate, tied up in an RDTOH account, forcing you to trigger even more tax just to access it. It's not that interest is bad, it's just not efficient inside a corp unless it's part of a dividend paying strategy. What you can do about it. So what are the smarter options? Number one, minimize interest generating investments inside your corporation, or at least balance them out with capital growth oriented assets. Number two, use capital gains as your primary source of corporate investment growth, since only 50% of the gain is taxable and you control when it's realized. Number three, defer income using low turnover ETFs, equity mandates, or corporate class investment funds. Number four, reposition interest heavy holdings into your RSP or TFSA, whether they're tax deferred or tax free. This isn't about chasing returns, it's about managing where your returns show up and not how much tax they cost. Part three, building a smarter corporate investment strategy. Now that you understand how interest and capital gains are taxed differently inside of a corporation, the next question is, how do you build a portfolio that grows efficiently without triggering unnecessary tax? Here's how we approach it with our clients. Number one, focus on capital appreciation over yield. In a corporate account, chasing yield can cost you. High interest GICs, bond ladders, and dividend heavy ETFs might look safe, but they generate fully taxable income every single year. Instead, focus on growth oriented equity funds, ETFs that defer gains, low turnover portfolios that don't trigger annual tax, or portfolios that have large capital gains attached to them. If you can control when the gains are realized, you can also control when tax is paid. And that's the key to efficient corporate investing. Use tax efficient structures like corporate class funds. Certain investment structures like corporate class investment funds or segregated funds are designed to minimize annual distributions. That means less interest and dividend income showing up on your T2 return. More of your portfolio growth stays unrealized and untaxed until you actually sell. That's a win if your goal is long-term accumulation inside the core. Using portfolios with large capital losses attached to them can also assist with deferring gains. Number three, coordinate your personal tax bracket. Sometimes the most efficient strategy isn't to keep everything inside the corporation. If you're in a low personal income year, approaching retirement, or already drawing from the corp, it might make sense to pay out dividends strategically, trigger RDTOH, or move funds out to invest inside a TFSA or RSP where income is sheltered or tax-free. The key is timing and making sure withdrawals fit into your broader tax picture. Number four, don't forget about the small business deduction clawback. Here's something a lot of advisors miss. Too much passive income inside your corporation, even from safe interest investments, can trigger the small business deduction clawback. If your corporation earns more than $50,000 in passive investment income per year, you start to lose access to the lower tax rate on your active business income. That means higher tax on your investments, higher tax on your business income, and a lot of missed opportunity. Another reason to structure your investments carefully. The bottom line, building a smarter corporate investment strategy isn't about finding the best investment. It's about aligning your portfolio with your tax reality, your time horizon, and your long-term business and retirement goals. Final thoughts. If you're investing inside your corporation, you already know how powerful that can be for long-term wealth building. But here's the truth that most people miss. It's not just about what your corporation earns, it's how it earns it. Interest income can quietly chip away at your after-tax returns, generating tax that you don't need to pay and limit other opportunities like the small business deduction. But capital gains, they give you flexibility, more control, and often a much better long-term outcome if you structure things right. What we do for our clients, when we work with incorporated business owners and professionals, we help people understand how their corporate investments are taxed, rebalance portfolios to favor deferred or lower tax income, coordinate with your personal tax withdrawals such as RSP, TFSA, RDTOH strategies, and ensure your retained earnings are working as hard and as tax efficiently as possible. Because this isn't just about returns. It's about protecting what you've built and making sure more of your hard-earned money stays with you and not the government. What you can do next. If you've built up $250,000, $500,000 or more inside your corporation and you're not 100% sure how your investments are being taxed or whether they're structured efficiently, now's the time to find out. book a free strategy call with our team and we'll walk you through what type of income your corp is earning, whether you're triggering unnecessary tax, and how to reposition your plan to grow wealth, not just on paper, but after tax as well. Just click on the link below to get started. And if this video helped you, make sure you like, comment, and subscribe. It helps more Canadians take control of their corporate wealth with confidence. Thanks again for watching, and I'll see you in the next one.